Hi, I'm Sharon Winsmith, a tax attorney, active investor, and your go-to resource for proven investment and tax planning strategies. In this video, we're going to do a crash course on my favorite tax planning strategy, which is the buy, borrow, die strategy. So this is a great strategy for anyone who wants to build wealth efficiently and understand how the wealthiest people in this country make billions of dollars while paying little to no tax. So I'm going to start by saying, yes, there are risks associated with the strategy. You need to make sure you really understand what you're doing and educate yourself on the investments you're making. Yes, it's going to involve using debt. And so there can always be risk associated with that. There are a lot of people who will say buy, borrow, die is too risky. I don't agree with that. I think it's risky for people who don't know what they're doing. But if you understand the strategy, the ins and outs of how it works, and if you're smart and make smart investment decisions, then I personally don't think this is risky. But just because the strategy is great for me doesn't mean that it's great for everyone else. So as I mentioned, this is just a quick crash course. I'm going to pack a lot into a pretty short video on this. I have a lot of other videos on buy, borrow, die, some very long videos on that. You can also take my course on the buy, borrow, die strategy. I'll link to that below. As I've said, before you implement and use this strategy yourself, you have to understand how it works, all of the benefits that you're trying to achieve, as well as the risk that you're undertaking by using this strategy. So to start with, I'm going to explain to you what buy, borrow, die is really quickly and how the strategy works. I'm going to talk to you about the key benefits of the strategy and why I think the strategy is so great. Then I'll also talk to you about how you can use the strategy and practice yourself, as well as how to repay the loan if you are going to use this strategy. So to start with, I'm going to just give you a quick overview of what buy, borrow, die is. I may talk about concepts that you don't understand. You might have to do separate research on that. I'm really just explaining the strategy. I know that there's some kind of foundational knowledge that you would need to have to understand some of the stuff I'm saying, but subscribe to my channel, check out my videos. These are things and concepts and terminology that you really need to understand if you want to get serious about building wealth. So to start with, what is buy, borrow, die? So this is the strategy that people like Elon Musk, Jeff Bezos, the wealthiest people in this country use in order to pay little to no tax. You can literally use buy, borrow, die in a way that you never pay another dime of income tax again. This is how Jeff Bezos is a billionaire and became a billionaire by founding Amazon while paying little to no tax in the process. This is a strategy that I use personally for my own investment. So no, you don't have to be a billionaire to use it. But let's talk about what the strategy is. So it's really kind of basic if you understand the concepts that are underlying what we're trying to do here. So the main point of buy, borrow, die is that you are not going to sell the asset. So the whole way the tax code works, especially with respect to investments or assets that you own, is that you do not pay tax until you recognize that gain. So I can own a share of stock in a public company, for example, that has appreciated, by hundreds of thousands of dollars, but I'm not paying a dime of tax on that appreciation until I sell that share. Now, I'm ignoring dividend income. Yes, if the stock pays dividends, you're going to have some tax on that if you don't do other tax planning. But we're talking about appreciation of gain in an asset. It can be a business you own, like Amazon for Jeff Bezos. His net worth was billions of dollars, but if he didn't sell a single share of stock of Amazon, he's not paying any tax on that gain. So that's the underlying premise on which the buy, borrow, die strategy works. So with that in mind, it's really just an easy 3-step process. Number one, you're going to buy an asset that you can own long term. The best assets, as Warren Buffett says, are the ones that you can own forever. Step two is that in order to access liquidity against that asset and to take advantage of that appreciation or value of that asset, the extent to which it's grown to, you are going to borrow against that asset. So you're going to actually take a loan out against that asset instead of selling the asset and triggering a taxable gain. Step three, and this is really just kind of the cherry on top of buy, borrow, die, is that you are going to die while you still own that asset, and you will pass that asset on to your heirs. So if that's your children, for example, they will inherit that asset. They will get a basis step up. They will get to step up the basis in that asset. And what that essentially means in short is that your children or heirs, whoever inherits that asset, could turn around the next day, sell that asset, and pay zero income tax on the gain. I want to be clear that buy, borrow, die applies to income tax. I am not talking about estate tax, property taxes. Yes, there's other taxes that could apply. We are talking about the main tax that we worry about, which is income tax. I have other strategies on estate tax and other things. So, subscribe to my channel for that stuff. But buy, borrow, die can be used in a way that you can have significant appreciations, even billions of dollars of appreciation in an asset that you pass down to your heirs, and the heirs can sell that asset and pay. No one at any point in the process pays any income tax on that appreciation. So you can have vast amounts of wealth escape any income tax. That is the beauty of the buy, borrow, die strategy. So again, it's just a 3-step process. You're going to buy an asset that you own long-term. You're going to borrow against that asset to the extent you want to have liquidity or take advantage of the appreciation in the asset. You're going to borrow against the asset instead of selling the asset, because if I take a loan out against an asset, that's not a taxable transaction to me. But if I sell that asset, that is a taxable transaction. So instead of selling, we're going to step 2, borrow against the asset, use that money in various ways, which we'll talk about later in this video. And then step 3, you're going to still own that asset when you die. Your heirs are going to get the basis step up so that there's no gain when they turn around and sell that asset themselves. Now, you may be saying there's never assets that I would own long-term. People say that. I don't know why they say that. That is not true. I own plenty of assets that I will never sell. I own assets that I don't even think my children will sell. I expect my grandchildren and so on to inherit those assets. So I'll link to my video below where I talk about specific examples of assets that I think are things you could own long-term potentially. So don't listen to people who say, you would never want to own a business forever. Well, I'm sure Jeff Bezos is happy to still own stock of Amazon. So that's not true. Plenty of people own businesses for their lifetime, pass it down to their children, let their children turn around and sell it. So don't let that be something that prevents you from looking at the strategy. There's a lot of misconceptions and just factually inaccurate statements that people make about buy, borrow, die. So that in a nutshell is how the strategy works. Let's move on to talk a little bit about some of the key benefits of the strategy. So I'm not going to cover the risk in this video. If you don't understand at this point that there is risk with taking out a loan against an asset, then this is not the right strategy for you. There are risks. Anytime you use debt, there's risk, right? You could have the value of the asset that you're borrowing against go down, to zero, and then you still are liable for that debt. You could have a situation where you borrow against one asset and then invest in another asset with that money, and both of those could go to zero. So those are always possibilities, but they're not really, risks that you can't be managed by educating yourself, understanding what you're doing, and really, really going through this strategy in detail so you understand the ins and outs. If you want to dive into the risk more, check out my course below on buy, borrow, die. That's definitely something you need to know, but I think the risks are obvious, and I'm assuming that you're going to educate yourself before you ever, do this. So with that said, and putting the risk aside, let's talk about the key benefits of this strategy. It is very important that you understand the benefits of what we're doing. A lot of people, a lot of really smart financial people out there, especially on YouTube, YouTube finance people, they get this wrong. They misunderstand a lot of the benefits. And when I hear them say things about buy, borrow, die that are incorrect, I think, oh, they don't really understand. They're missing this benefit of it. So we're going to just run through these in detail. Again, this is a crash course. I'm not spending a lot of time on this, but you need to really think about, understand, dive into this in more detail so that you understand what you're trying to achieve here with buy, borrow, die. So number one, and probably the most obvious and best benefit of buy, borrow, die, is that you are not paying any tax on the gain. So that gain can be significant, and it's going to be significant over the course of your life, especially for those of us, who started investing really early and compounding returns over time and not selling. You're going to have significant gain in that asset, and you're going to be able to increase your net worth significantly quicker than if you were selling assets here and there and paying tax. That's just a fact. Run the numbers yourself if you want to see how different your situation's going to be in the long term if you're paying tax on gain as opposed to using something like this strategy. So, that one I think is pretty obvious, but it's the most important one that you need to understand here. Number two is that with step 2, with the borrowing against that asset, you are extracting out the value without paying tax. So if I have a share of stock that has appreciated, $100, for example, I can usually borrow against that asset or that stock and up to, 50% in most cases, and take that money and do whatever I want with it. So I'm actually able to get the benefit. People may say, well, yeah, I don't pay any tax on the gain, but I don't get to use that money. So this lets you extract the value out of that asset, by using a loan in step 2 when we borrow. So number 3 is that if you're using this strategy smartly, which is, you're going to, and I'll talk a little bit more about this with number 6, the double dip approach. If you're using this strategy where you're borrowing against asset 1 to invest in asset 2, you should get a tax deduction for the interest. You need to work with your CPA on that. This is a pretty basic concept. You might need to make certain elections in order to get the full deduction, or you might need to, just rejigger things and how you're investing to make sure you do get the benefit. But when you borrow against whatever, if you use an asset 1, borrow against asset 1 and invest in a business, invest in, another asset that's an investment, you get a tax deduction for that. It might be business interest expense or it might be investment interest expense. Either way, you should get to deduct that money, that interest you're paying on that loan. Yes, when you borrow, you pay interest. I see a lot of people talk about that as a negative here. If you don't understand that when you borrow or take out a loan, you're going to pay interest, please don't use the strategy. So you're going to pay interest, but if that's, if that interest is tax deductible, the cost of the end cost of that interest expense is a lot lower than, the face value of the interest that you're going to pay on that debt. So keep that in mind. You want to make sure that you're doing this in a way that you can get that tax deduction. So when people say, I see a lot of people say, well, the interest rate that I'm paying right now on my SBLOC is 6%. That's too high. Well, that's not too high if you know what you're doing. And also that's the pre-tax rate, right? So what's the after-tax rate of interest that you're paying? That's what's important here. Number 4 is that you get to increase returns through the use of leverage. So you're going to be able to borrow against one asset, take that money out, pay, a small amount of interest, because with SBLOCs, it should be about the lowest cost borrowing interest expense, for any loan that's available to you. And you can invest that money in something else that's making a lot more money. So when you use leverage, if you do it smartly, you should be able to significantly increase the returns that you're making over time. And that is what's another reason, one of the many reasons why the strategy is so great. You can also diversify investment. So I might have, a share of stock that's appreciated significantly. And it's like, well, too much of my net worth is tied up in that stock. Well, what I can start doing is borrowing against that stock and investing in other assets like real estate. It allows you to diversify the investments you're making without triggering tax. So that's just another great benefit of buy, borrow, die. So the double dip approach, I'm going to talk about this really quickly. This is pretty basic concept when you understand the terminology of what we're talking about here. But double dip with buy, borrow, die is the best way to use this strategy, in my opinion. If you're going to borrow against an asset for personal reasons, so if I borrow against, an asset, and this is how Jeff Bezos and Elon Musk can use this strategy to some extent. They might borrow against an asset to pay rent. I mean, I'm sure they own homes, but whatever it is, it's personal expenses. You're not getting an interest expense deduction for that when you use the borrowed money for personal expenses, but you're also exposing yourself to other risks there, right? With the double dip approach, which I think is the safest way to use this strategy, if you know what you're doing, is to borrow against asset 1 and invest in an uncorrelated asset 2. So I talk about this more, how I use this strategy in practice with my own personal investments in my buy, borrow, die course. But you need to understand double dip approach. You're borrowing against one asset, you're paying a small amount of interest, and you're investing in asset 2. And the benefit there is the arbitrage, right? Between the return, the after-tax return you're getting on investment 2 should be significantly higher than the interest expense that you're paying on that loan for asset 1. And that's just additional return that you're getting in addition to returns on asset 1. So you own asset 2 and asset 1, and you're always getting the returns in asset 1 because you never sold it. So that further appreciation is still increasing your net worth over time. And then asset 2 should be kicking off returns that exceed the interest expense you're having to pay on the loan. So I'm not going to dive into this in any more detail. I just want to go through this stuff really quickly. That is the best way to use this approach. People say things, crazy things like, well, you're just having to, invest to get a return in excess of the interest expense. If you were not able to invest your money in a way that you can exceed, 6%, 7% SBLOC interest, which is what it is at really high interest rates right now. I used to pay less than 2% on my SBLOC. So it's anywhere, in that range. If you can't invest money in a way that you're exceeding that, I don't know what to tell you, right? So you need to make smart investments. You need to stop buying into this logic of you can only get 4% or 6% returns. that's really not what sophisticated investors are getting, right? I usually get returns that exceed 20%. Anyone can easily exceed 10% because that's what the S&P 500 kicks off on average every year. So don't buy into this baloney that, it's hard to get returns that exceed the interest expense. If you know what you're doing and educate yourself, that shouldn't be that hard to do. So that's the double dip approach. That is very important. I use this strategy mostly for that, using that by borrowing against one asset to invest in asset two. And I think that to me is what makes this strategy so incredibly powerful. So the last point I'm going to mention is asset protection benefits. One of the best asset protection tools is debt. So for example, if you have, a rental property that you own and, you're going to have a lot of debt on that, right? Because the whole point of investing in one of the points of investing in real estate is that the ability to use a lot of debt at low borrowing cost in order to, amplify returns. So if something happens on that property and someone sues you, they've got to get in line behind the bank, right? So anyone the bank or whoever has the debt, on that asset or whatever it is we're talking about, they're going to be first in line. So there's asset protection benefits to having an SB lock against your shares of stock. There's asset protection benefits to having an SB lock against your rental properties, to having a loan or mortgage against your rental properties. There's asset protection benefits to having a loan on your business. So that's just kind of an extra benefit that I don't see a lot of people talk about with buy, borrow, die. That I think, for someone like myself who really focuses on asset protection, I think that's a great strategy or just another kind of, great benefit to buy, borrow, die. So I want to just go quickly through how you can use the strategy in practice. You may be thinking, well, yeah, Jeff Bezos can borrow against Amazon. Of course, I would be happy to borrow against Amazon and Elon Musk. The strategy is obviously really easy for billionaires, but how do the average, Janes and Joe investors like ourselves use this? So I use this strategy all the time. I am not a billionaire, but I've used buy, borrow, die for a long time as an investor. And I can tell you that anyone who has some money to work with, I see a lot of people say things like, what are the minimums for SB locks and stuff like that? Maybe you're not ready yet to do that. If you're worried about having a minimum amount, then that's probably not the right point. But, if you've got six figures or, more that you're working with here, then you can use this strategy if you understand what you're doing. So the double dip approach, there's lots of different ways. Check out my videos. I'm not going to link to them all below because I have tons of videos on buy, borrow, die, SB locks. It would, be too long to link to all of them. But you can use this to borrow against one asset and invest in another asset. You don't need to be a billionaire to do that. Anyone, who has some money in the stock market can do an SB lock. Should anyone do it? No. But if you're smart at what you do and understand what you're doing, then that might be something that you should look at. So, the double dip approach, it could be, check out my course for how I do this in practice and great ideas as far as like how I set up my personal investments to do this. But you can borrow against your shares of, public stocks, bonds, if you invest in bonds and invest in something else. You can borrow against your business if it's got, certain like inventory or other things that make it easy to borrow against, or if the business value is worth enough. So, whether it's to fund, business expansion or start, whatever it is, you just need an asset that you can borrow against. That might be stocks. It might be bonds. It might be, real estate, rental properties. It might be a business you own. You need asset one that you can borrow against. And then how can you use those funds? You can use it to invest in other assets with a double dip approach. You can use it to fund your business. So, and I've done this in the past where I might borrow against, public stocks to fund my starting a new business or acquisition of a business. If I'm looking at acquiring a business, the first place I'm going is to an SB lock because that's the lowest cost of borrowing that's going to be available to me. It's going to be much lower than an SBA loan. There's going to be a lot less headache in trying to get the loan approved. And it's just, if you've ever gone through going and getting a bank loan, you know what kind of headache it is. You can use the loan, for a down payment on rental property. Again, if I'm looking to invest in real estate, I may or may not look to my stock portfolio. I'd probably would go to the bank and see what kind of mortgage I could get because mortgages are also low cost interest. But if you need to fund a down payment, so, usually the bank's going to require you to put 10 or 20% down. If you need to fund that down payment, you could borrow against, your stocks, or you could borrow against your business to do that. There's all kinds of ways that you can use buy, borrow, die in practice when you're not, a billionaire. So don't, again, the whole point that I'm trying to say is that don't let yourself think that the strategy doesn't apply to me just because I don't have, hundreds of millions of dollars. Also, I wouldn't necessarily recommend most people do this, but you can fund personal living expenses. I've used this strategy this way because I'm a very efficient investor, and because, I know about it, it might be better for me to avoid paying the tax and use the strategy in a way that I do that and still keep the money invested, especially when you're making decent returns on that money. But I would be very careful if you're going to borrow against an asset to fund your personal expenses. Yes, Jeff Bezos and Elon Musk may do that. Yes, I've done that, at times, but you need to be very, very careful there. I wouldn't recommend it to someone who isn't uber sophisticated and really understands what they're doing. The last thing I'm going to touch on, because I get asked this question a lot, is how do you repay the loan? So I will admit, I get a little annoyed when I see this question, over and over. Well, how do I repay the loan? So you need to repay the loan, right? You're taking out a loan against an asset that is debt, that, someone is lending that debt, giving you that loan, and yes, they're going to want their money back. Sometimes you don't necessarily have to actually make payments on that, and I'll talk about that. That's with SB locks. But, when you go and take a mortgage on your house, or go out and to buy a house you're going to live in, which is a liability, nobody asks, how are you going to repay that loan? You need to have the ability to repay the loan, right? Please don't ever take on debt, even if it's using a good strategy like buy, borrow, die, if you don't have a way to repay the loan or have a strategy around that. So if you're not doing an SB lock, I'm going to talk about an SB lock in a minute, you're going to probably have to make current payments of interest and principal. How do you do that? Lots of times it's through business profits. So, I've seen people when, they have uber successful, very profitable businesses that are kicking off so much cash that they don't want to sell it because they don't want to sell the business, or they also don't want to pay tax on the gain, but they want to take some money off the table and start investing. They want to start diversifying. They might need to, pay personal expenses, whatever it is. You can borrow against that business. You might need to gross up the borrowing for the debt service, or your business profits in most cases are, making enough money that they can also pay down the debt. And there's some tax benefits because you might be able to get a tax deduction on the interest expense. So I don't care how you repay the loan. I don't care if you borrow from your aunt or, if your aunt gives you money. I don't care if you use W-2 salary income. You just need to have a way to repay the loan. I mean, I don't understand why that's so controversial. People who are using this strategy are very wealthy. They're flush with cash in a lot of cases, or they have, the ability to access cash. So if you're asking questions about how do I repay the loan, then, this might not be the right strategy for you. But people use this strategy all the time, with business income, with, other sources of cash. I'm not a fan of W-2 full-time employees because it's just the most inefficient way to make money. But I know a lot of people who are, very high income salary who then invest their money using buy, borrow, die. So maybe they're using their salary to repay the loan, against real estate or whatever it is that they're using. Also, asset two, if you're doing double dip approach, and this is the way most people use this strategy in practice, is asset two should repay that loan, right? So if I'm borrowing against asset one to invest in a new business, for example, so say I have, S&P 500 index fund, I'm going to borrow against it to fund the acquisition of a new business. Well, hopefully that business can pretty quickly repay that loan that I have on that stock. So that's one way to do it. Again, it doesn't matter. You just need to be able to repay the loan. You need to be smart about that. If you're using an SB lock, and so an SB lock is, I'll link below to what that is because you do need to understand that. That is when you're borrowing against your shares of stock or bonds, and you're just taking out a loan against your, portfolio of public stocks. So in that case, you can just let the interest accrue over time and never repay the principal. You can leave that outstanding indefinitely as long as you meet their margin requirements. You need to be careful there. So, you can easily see how someone could get themselves in trouble with this, but you can also easily see, if you understand what you're doing, how this is a great strategy. I do not ever pay down my SB lock. It doesn't make any sense for me to pay down my SB lock. I get tax deductions on the interest expense that I let accrue every year. I'm still getting those deductions. Yes, it's accruing. Yes, it's accruing daily, but I am far outperforming that interest expense. And, I'm still saving the tax that I would have to pay on my stock. So you've got to understand what you're doing with the SB lock if you're going to leave things outstanding like that. Just because you don't have to pay interest or principal doesn't mean that you should do that. I know people who just, they can't sleep at night if they do that and just let everything accrue and see that balance get bigger and bigger. So you got to do what's best for you. You got to do what you understand. check out, I have a ton of videos on SB lots because I think those are great wealth building tools, but they can also get you in a lot of trouble. So this was just a quick crash course. This is not, meant to be fully inclusive of everything you need to know about buy, borrow, die. Yes, there's risk. You have to understand that you're undertaking. You have to really, really understand what you're doing. I highly recommend you check out my course. It's my most popular course on buy, borrow, die. This is a strategy that the wealthy do. Wealthy people do not pay tax, and this is largely the strategy that they're using to do that. So I highly recommend it. I think it is the, best tax planning strategy out there. But it's only good for people who know what they're doing, are willing to invest the time, and understand the risk that they're undertaking by taking on a loan. So hopefully you found this crash course helpful. Check out my other videos on buy, borrow, die, and subscribe to the channel so you make sure you see content like this in the future.